Ever wondered how counterparty management has evolved since the 2007 to 2008 financial crisis? Get ready to embark on a journey that explores this compelling transformation. Picture 2008. The world was reeling after a financial crisis that saw major institutions collapse. This marked a turning point, driving a revolution in counterparty management. Stricter risk assessment and better regulation became paramount. Enter Basel III, a regulatory framework introduced in the wake of the crisis. It aimed to create safer, more resilient banks by setting higher capital requirements, improving risk management, and enhancing liquidity standards. Basel III, in essence, required banks to maintain enough capital and liquidity buffers to withstand economic shocks. The Basel III Accord doubled the minimum capital requirements from the previous 2% under Basel II to 4.5% of a bank's risk-weighted assets. Furthermore, an extra buffer of 2.5% was added, pushing the total minimum requirement to 7%. Alongside Basel III, the International Swaps and Derivatives Association, better known as ISDA, set global standards for derivatives. ISDA master agreements became the go-to for defining terms and conditions. The association's work in reducing counterparty credit risk, increasing transparency, and improving operational infrastructures demonstrated its commitment to robust, stable financial markets. Clearinghouses emerged as vital intermediaries in the financial market. By validating and finalizing transactions, clearinghouses ensured that both buyers and sellers honored their contractual obligations. Options, warrants, swaps, futures forwards, and more. These derivative products, which derive their value from underlying assets, started to gain prominence. Collateral management became a key risk mitigation strategy. It involved the exchange of assets or cash to cover potential losses in the event of a counterparty default. Initial margins, the collateral set aside at the start of a trade, were introduced to cover potential losses. Valuation margin, on the other hand, was used to adjust for daily changes in a contract's value. The relationship between market risk and credit risk can be quantified by the difference in value between a credit risk-free portfolio and an identical portfolio that takes into account potential changes in creditworthiness. This difference is termed the credit valuation adjustment, or CVA. Regulatory authorities stepped up to ensure transaction validity and proper risk management through audits, reporting requirements, and compliance checks. Documentation became crucial in counterparty management, helping to ensure transparency and accountability throughout the process. Counterparty management evolved to encompass the pre-trade phase, trade execution, and post-trade activities, each with its own set of complexities and requirements. Uncleared margin rules were also introduced, adding another layer of protection against counterparty risk. From the ashes of the 2007 to 2008 financial crisis, counterparty management has risen, transformed, and matured. Basel III, ISDA, clearinghouses, collateral management, and regulatory oversight have all played their part in this evolution. As we navigate the global markets of today, these changes continue to safeguard our financial systems and ensure stability in an ever-changing world.